All right, what's up everyone? This is Scott here again with my next video, and today is a very interesting day because this is the first month where the Federal Reserve is finally going to start unloading its hundreds of billions, if not trillions of dollars of assets that it has been acquiring all throughout COVID. Right, so basically, if you've ever wondered why the stock market was doing so well in 2021 and after the market bottomed in 2020, right after the COVID crash, why the market exploded higher after that point, it's exactly because of what the Federal Reserve was doing all throughout that time. And so again, today is the first day where the Fed is going to start doing the opposite of what they have been doing all through COVID. They are no longer going to be supporting financial markets nearly to the same extent as they have been. And as a result, I do think there's going to be some major downside effects. And for those of you who have been watching my channel for some time, if you've also wondered why I'm such a huge bear on this market, well, this video is going to show you exactly why. And so for this video here, we're first going to go over this article briefly, which is going to very clearly lay out exactly what the Fed was doing during COVID, and also by extension, what they were doing through the 2008-2009 housing crisis, and then what is going to be changing as of today, June 1st. And then after that, I'm going to show you a very interesting macroeconomic chart, which is also going to make it very clear as to what the likely outcome of this major change is going to be in the near future. Now, as always, though, before we dive in case you guys are interested in getting some free stock or quite literally some free money, I've got some very cool promotions and opportunities in the description of this video, so check them out. Right, so for example, if you want $200 of free stock from Tastyworks or a bunch of free stocks from Webull, free money from SoFi, etc., again, check out the links in the description of this video. And then secondly here, in case any of you are new to the channel, again, my name is Scott, and I just want to let you know that you can also find me on Skillshare as well, where you can take my very detailed classes on options trading or stock market investing. And I also provided some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you sign up for Skillshare using any of those links, you'll get a full 1 month free trial. Okay, so now diving in here, and like I mentioned, first off, we're going to go over this article, and I'll also post a link to it in the description of this video below so you can check it out as well. The title here is "The Federal Reserve Policy You've Never Heard of Could Have the Biggest Effect on Your Wallet." And so, of course, here they're referring to the Federal Reserve's quantitative easing process. And this policy was first used basically back in the 2008-2009 housing crisis when the markets and the economy actually took a major nosedive. And so to explain what that is, I think this article here sums it up pretty nicely. So we'll go ahead and scroll down a bit, skip a few paragraphs that we'll return to in a moment. And right here, I think, is a great summary of what the quantitative easing process is. So basically, it's a massive bond buying campaign by the Federal Reserve, where specifically during the coronavirus pandemic, the Fed amassed almost $4.6 trillion worth of bonds, including treasuries and mortgage-backed securities. So quite literally, the Federal Reserve was printing money to buy $4.6 trillion worth of these bonds. And the whole point of doing this was to help push interest rates that the Federal Reserve does not normally control down to rock bottom levels. And this includes all kinds of interest rates like mortgages and student loans, credit card rates, etc. And these low rates also have the effect of bolstering liquidity in financial markets and basically keeping the entire economic system awash with credit. So basically, the bottom line here is by keeping rates very low, by purchasing all these trillions of dollars of bonds, that also has the effect of making money very easy to borrow. And therefore, that has the effect of providing a lot of stimulus to the overall economy. So of course, during COVID, a lot of businesses suffered greatly, right? They either had to close their doors or drastically reduce output, which in either case means far less revenue. But then, if money becomes very easy to borrow, they can take out loans to support their businesses through COVID, or for individuals, we all got those stimulus checks, things like that. That's why the Federal Reserve made this decision to purchase $4.6 trillion worth of bonds, and also other assets as well. And again, keep in mind, this began actually back in 2008 and 2009 with the housing market crisis, and it never actually stopped. And in fact, you can see that right here in this graph. This is the Fed's bloated balance sheet during the recession of 2007 and 2009, where at the beginning, before the recession, the Fed's balance sheet was only around $2 trillion. But then to try and save the market and save the economy, the Fed started printing tons of money to acquire all these bonds, thus causing their balance sheet to drastically increase. And so ultimately, like I mentioned, the Federal Reserve never stopped doing this since 2009, but during COVID, they dramatically accelerated things once again. And now that brings us to today, where the Federal Reserve has finally made the choice to start unwinding or undoing all of this massive purchasing of bonds and other assets. So now if you scroll back up to the top of this article here, you can see right there, starting June 1st, which is today, the Federal Reserve is going to let $47.5 billion worth of assets roll off their books or roll off their balance sheet. And then that number will increase to $95 billion by September. And then if you scroll down a bit more, you can see a more visual timeline of what the Fed's going to be doing here. And so here we go again in June, $47.5 billion of assets are going to roll off this month. Then July, same thing, $47.5 billion. August, same thing. But then beginning in September, it's basically going to double. So essentially every month now, the Federal Reserve is going to start unloading a massive portion of their balance sheet, right? Instead of purchasing all these bonds, they're going to start selling them. And then down below here, the big picture, at this pace, the Fed's balance sheet would reach its pre-pandemic size by June of 2026. So come September, even unloading about $100 billion of bonds per month, it's still going to take about 4 years just to get back to where we were before COVID. And so also, hopefully that puts it into perspective a little bit as to just how much stimulus the Federal Reserve was injecting into the economy, into financial markets to keep things afloat during COVID. And then finally, one more thing I want to point out in this article, if you scroll down a little bit here. And so lastly, I want to direct your attention to these two paragraphs right here, which is basically comparing the Federal Reserve's decision to start unwinding their balance sheet today compared to the last time they did that in 2015. So basically, the last time the Federal Reserve began to start dumping a lot of the bonds they had acquired on their balance sheet, the Fed waited almost 2 years before doing so. Or basically, they waited 2 years after they hiked interest rates for the first time after the financial crisis of December 2015. And now this time in 2022, the Fed is waiting just 3 months. So the Fed is definitely acting at a much, much faster pace now. Moreover, as you can see here, many years ago, previously Fed officials chose to gradually increase how many bonds would roll off their portfolio or their balance sheet over a 12-month period until it eventually hit $50 billion per month. Again, this was all back in 2015 or prior to that. But now today in 2022, the Fed is moving 4 times faster, and also its monthly cap is nearly twice the size, right? Again, come September, it's going to be about $100 billion per month, not 50. So not only is this whole quantitative easing process still an experiment, right? Because it did not even begin until 2008 with the housing market crisis, and it has not stopped ever since. But now the Fed is going to be accelerating things at a faster pace than ever before. And for good reason, of course. They have no choice but to do this because, as I've said in previous videos, the Federal Reserve is the cause of inflation. And if it's not the only cause, then it's definitely the main cause. And the reason for that, of course, is when you print quite literally $4 trillion of money to buy bonds and to keep rates very low and therefore encourage others to borrow money and increase debt and things like that, that has the effect of devaluing your currency. Right, this here is very basic economics, Econ 101, where when the supply of anything goes up dramatically, including currency, the value of that product goes down significantly. So ultimately, we have trillions of more US dollars floating around in the economy, and it's also very easy to borrow those dollars because, of course, rates are near zero. Therefore, that has the impact of devaluing the US dollar. And bottom line, because of that fact, it now takes a lot more US dollars to buy things, gasoline, food at the grocery store, your rent's going up, of course, anything. All right, so hopefully that gave you a good summary as to what the Fed has been doing during COVID and also back during the housing crisis and what the major change is going to be starting in June here. But now let's take a look at a graph that I think is going to have a very accurate assessment as to what's going to happen in the coming future. So now I'll come over here to this next page. And so this graph here and all this data comes from the Fred website. I'll also post a link to this graph down below as well. But basically, Fred is a great website to look for very accurate macroeconomic data on the United States. And so what you're seeing here are 2 graphs. The one in blue here is the Federal Reserve's balance sheet going all the way back to 2005. And then in red here is the S&P 500. Now, unfortunately, for some reason, the S&P data does not go back all the way to 2005, but still we can focus first on this zone right here, which was the housing crisis, and we can at least see the massive jump of the Fed's balance sheet during that time. So again, this really was the beginning of the whole experiment that is the quantitative easing process from the Federal Reserve. Right prior to this event, the Fed's balance sheet was relatively small, under $1 trillion, and it really was not changing hardly at all on a year-to-year basis. But then, of course, the entire economy fell apart back in 2008, and the Fed really had no choice but to bail everybody out, right? All the major banks on Wall Street, along with helping to provide stimulus into the economy. So therefore, we saw the first big jump in the Fed's balance sheet, right? Buying hundreds of billions of dollars worth of bonds, etc., other assets too, all with the intent to basically help bring the US economy out of that recession. But like I said many times at this point, the whole quantitative easing process never actually stopped since then. Of course, during this zone, the Fed's balance sheet definitely plateaued, which is nice. At least they took a breather from printing all this money. But still, in basically 10 years or so, the Fed's balance sheet went from under $1 trillion to well over $4.5 trillion. And then now let's fast forward into recent times. So on the S&P chart here, this was the major COVID crash back in 2020. And while the market was crashing, look what the Federal Reserve decided to do once again. Literally in the span of a month or two, the Fed's balance sheet went from around $4 trillion all the way up to $7 trillion. And then, of course, as a result of that, look what the market did in response. So this was my point earlier in this video, where the reason why the market bounced so much in 2020 after the crash, and also why the market had such a great year in 2021, it was pretty much entirely because of what the Federal Reserve was doing. Printing trillions and trillions of dollars, buying bonds, keeping rates low, injecting liquidity into the market, and basically acting as the major support of both the economy and the financial market system. And even after this massive initial jump, it still continued higher after that, reaching a high of just under $9 trillion. So once again here, this line in blue, this is the reason why inflation is so bad right now. The Federal Reserve has massively reduced the value of the US dollar. It's as simple as that. And then now, starting today, the Federal Reserve is finally going to begin unwinding its massive balance sheet. So now we're going to start seeing the Federal Reserve beginning to sell all the bonds and other assets it had acquired during COVID, which of course is going to have the opposite effect now, right? So interest rates, for one thing, are going to start increasing rapidly, and we've already seen a little bit of that so far in 2022. But now also, what do you think is going to happen when the Fed basically pulls the rug out on all the financial support that it's been giving the economy and financial markets? Right, basically, once the Fed starts to dramatically decrease its balance sheet here and pull liquidity from financial markets and from the economy in general, I do think we will see the stock market follow in suit. Right, again, the market here followed the Fed's balance sheet all the way during COVID when the balance sheet was increasing. Of course, that was the intent. So now, of course, when the exact opposite occurs, that pretty much leaves you with only one possible outcome. The markets are going to continue going down. And the crazy thing also is, so far this year, all the major market indexes are already down huge, and the Fed has not even begun. Today's only day one of beginning to decrease its balance sheet. And also do keep in mind, the Fed plans to unwind its balance sheet, not just for a few months, but for many years, at least until 2026, assuming they stay on pace. And so, of course, while I'm certainly not trying to predict the future by any means, I do think my assumption here basically is that we could see a multi-year long bear market. Right, and in fact, the major bull market we have seen ever since the bottom of the housing crisis in 2009 all the way to today, a lot of that mostly was due to the Federal Reserve's continued use of quantitative easing. Right, there's a reason why this past bull market was the longest bull market in history, because the Federal Reserve has never interfered with financial markets to this extent ever before. And now ultimately, as a result of all this, inflation has finally hit the point where it's out of control, and the Fed has no choice but to completely backtrack on their support of the economy and financial markets. Right? Basically, all of this crazy printing of money and purchasing of bonds and just going crazy to support everything, it's not sustainable, especially in the past 2 years here. And so there you go. I hope this video gave you guys a good summary and a good overview of not just what the Federal Reserve is going to be doing here starting June, but also what the major impacts or consequences of this change are going to be. I also don't want to scare anybody into, selling off all their stocks or things like that. Of course, like I said, I could be wrong about this. This is just my logical way of thinking about our current situation. And if you also share my opinion on this as well, now you have the knowledge to react and possibly protect yourself, protect your portfolio basically, from what could be a multi-year bear market. And perhaps that comes in the form of maybe selling off a few of your more risky investments, the companies that either don't have profit yet or that are still very small, etc. Or maybe also moving a part of your portfolio into cash and just having fewer stock investments, right? Because also with rates going up, it's going to be better to hold cash in the long term as opposed to risking everything in the stock market or elsewhere. But of course, that's totally up to you. I just wanted to present this information to you all so at least you have it and you can respond to it in your own way. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want some free stocks or some free money, then check out the cool promotions and opportunities in the description of this video. And also, if you have an interest in taking some detailed classes on options trading or stock market investing, then check out my Skillshare courses. Links also in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.